Awesome. Well, welcome everyone. Today is session 8. It is Thursday, September 17th, and we're here to talk about the events of the day. To kick it off, we'll talk about central bank activity. We see that Powell spoke on Wednesday, had a very exciting news conference where he said pretty much what was exactly expected. Because of that, we saw the curve steepening slightly coming out of Powell's remarks. We saw that Powell stayed dovish as expected, with no rates cuts indicated until at least 2023. Rates rose slightly across the board, with the 10-year trading 1 basis point higher, which again means the price is lower given that prices and yields are inversely related, to 67 basis points. And the 30-year is running about 146, raising 3 basis points there. Powell noted that until labor market conditions have reached levels consistent with the committee's assessments of maximum employment and inflation has risen to 2% and is on track to moderately exceed 2% in the short term for some time, we will keep rates constant. This is really important to note and really epitomizes the sentiment that he has had in the past, where he's now noting that we're going to exceed this 2% symmetric inflation target and target 2% over the entirety of the business cycle. Interesting things to note coming out of the FOMC meeting are that 99.8% of Fed's Main Street lending facilities remain unused. This is a whopping number. This is extremely high. And considering that only 0.2% of the Main Street lending programs were used, an even smaller number of muni lending facilities were used, with only 2 lenders actually accessing these facilities. With this in mind, we saw gold futures end down a little bit more than 1% after finishing the highest in more than 2 weeks the day prior and rallying with a weakening dollar through the global easing cycle of the past. Considering the Bank of England, we are considering the possibility of negative rates. The Bank of England is making a structured engagement with the UK bank regulators to talk about the probability of negative rates. The pound has fallen. And gilts reversed their drop after the Bank of England said that they were considering this endeavor. And this pushed the cable rate to 128, which is the exchange rate between pounds and US dollars. Andrew Bailey, the head of the Bank of England, noted that negative rates are on the table, even though the key rate is already at 0. Markets are pricing in this possibility of negative rates, which means it's not only just a possibility that they're talking about, but something that the financial markets truly think is likely. This is with in mind considering that wage support is going to run out next month, and the whole situation with Brexit and Boris Johnson wanting a hard exit from the EU, still holding that October 15th deadline. Considering the Bank of Japan, we see that they are maintaining their policy rate at negative 10 basis points, which is their equivalent of the federal funds rate. This was the first meeting under the new Prime Minister, Yoshihide Suga. In addition, New Zealand may also consider negative rates. This is an era of unconventional monetary policies seemingly becoming conventional. Also, back stateside, we saw that on Thursday morning today that U.S. jobless claims fell to 860,000 jobs instead of the 850 estimated. However, that is 20,000 jobs better than the 880 of the last 2 weeks. Because of this, markets were pretty muted. In addition, U.S. housing starts rose a little bit to 1.42 million, below the estimate of 1.49. However, again, above previous estimates. We see a recovery happening, although the estimates are consistently beating what actually happens. On the left-hand side of your screen, you'll see the chart representing the amount of negative yielding debt in the global economy. We see that according to Bloomberg, we have this huge spike in the amount of negative yielding debt. This is going to grow substantially once central banks like the Bank of England and Bank of New Zealand decide to pursue this negative yielding policy. Considering the big stories of the day, the first thing that's always front of mind is Corona updates. We've seen New York delay the start of in-class learning to October. JP Morgan yesterday morning made a huge statement about wanting to get more traders back to work. However, by the end of the day, that same day, there had been cases reported at the JP Morgan offices. With that in mind, other banks have been rolling back their provisions of trying to get people back into the office. People like Larry Fink at BlackRock have recently noted and commented on how difficult and arduous a task it is to maintain company culture as you stay in this work environment working remotely. Someone at Goldman Sachs also did get sick today. So we see this emphasis from banks of getting people back in, however, seeing the dire consequences quickly. Considering oil prices, they are above 40 for the best week in months. The OPEC has warned that a second wave could derail the demand recovery, and the Saudi Arabian country kept members in check, with Saudi Arabia chastising non-compliant members for trying to fool the market with overproduction. This outwardly statement affirmed the notion that the laggards have until December to make up for any overproduction numbers this far. Saudi Arabia has also warned to speculators that they should not be betting against OPEC and should not be shorting oil prices. This is a vote of confidence and should be pretty interesting, seeing that Brent is now trading at 43 points and WTI is at 41. In addition, the largest bank in Spain is now going to be the merger of Caixa and Bankia. So they have agreed to their merger, making themselves Spain's largest bank with assets of over 650 billion euros. Bankia is a state-controlled bank that has played a prominent role in Spain's financial crisis when Madrid injected a little bit over 22 billion euros to remedy the vast capital shortfall of 2012. As a combined firm, they will have the largest market share in terms of domestic loans and domestic capital outstanding. However, Santander and BBVA also have a much larger international presence. However, domestically, this new merged company will sustain quite a prowess. Considering Apollo, the large private equity giant headed by Leon Black, is said to be weighing a deal of a little bit over $10 billion to a German plastics firm, Covestro. Covestro was spun out of the drug maker Bayer AG in an IPO in October 2015, and shares have risen 68% since then. They've halved in price since a high in early 2018, and the current market value is a little bit over that $10 billion US dollar figure. Apollo actually has broad experience in the plastics industry. A lot of people know them for their strength in distressed debt, which is where Leon Black kind of grew up trading. But considering their strength in the plastics industry and their LBO growth equity side, they have made prior investments in plastic makers like Linden Bassel Industries, which held up as a textbook model for a start to finish private equity transaction that did an amazing job there. So it'll be interesting to see what happens. Considering the market for U.S. leveraged loans, in September, nearly a quarter of the leveraged loans domestically have been sold to fund private equity dividends. This is particularly interesting because dividends are essentially an interim prize for the operational and financial improvements of a company. This is not the end result. This is merely something that you're getting in between. Legally, a dividend could actually be clawed back if a company goes bankrupt quickly after the payout. So this is something to watch when companies that already have high levels of financial leverage are going through this dividend process through leveraged loans and CLOs. And the overall dollar volume of dividends so far in 2020 has been a little bit over 9 billion US dollars. This is less than half of the figure from 2019. However, this is reflected because of the sharp drop in loan issuance when capital markets basically froze coming out of the crisis in March 2020. Dividends are now a substantially larger portion of the market, especially for firms like TPG, Apex, and Dragoneer, large firms themselves. On the right-hand side of the screen, as usual, you can see market performance. Market performance was pretty muted across the board, slightly down, but pretty much flat, within about 1% in the U.S. indices. Moving on to deep dives, there are two very exciting stories to talk about. Firstly, Delta has done a debt issuance where they've issued frequent flyer-backed debt to sell for a little bit over $9 billion. This is raising $9 billion in capital through both bonds and loans through a new credit facility. They had $6.5 billion planned as of Monday. However, they amended this to make it $9 on Thursday morning. Miles are one of the biggest assets for, or I guess the biggest revenue driver for a company like Delta or one of the big airlines more broadly. Considering in 2019, Delta renewed its partnership with American Express, and one of the biggest reasons that they gain revenue from these from these loyalty points is that they can then be sold to credit card companies. These miles are sold to incentivize people to buy the card and choose to buy the Amex or buy the MasterCard and allow the credit card company to earn revenue that way. In 2019, American Airlines earned about $5.6 billion in loyalty and related revenues. Delta had 9.1, and United Airlines had a little bit over 5. Delta, as you can see, had the largest and represented about 19% of their top line. Delta is the industry leader in monetizing loyalty by the numbers. And in 2019, it did renew that partnership. The 2 series of notes that will be issued on September 23rd will come along with a credit facility. With the notes, we see 4.5% notes due 2025 and 4.75% notes due on 2028. These notes are secured, obviously, by the assets in this frequent flyer subsidiary, which is the program that's the Sky Miles IP Ltd, which is the newly formed entity that they've created as something considered an indirect, wholly owned subsidiary. This means it's incorporated in the Cayman Islands and it's a limited liability, which will come into play if they go through a bankruptcy reorg and some sort of Chapter 11 restructuring. However, in good times, that's not necessarily too relevant other than for tax purposes. So $2.5 billion of notes due in 2025, $3.5 billion of notes due in 2028. And they also have a credit agreement for $3 billion term loans, which is a TLA, which will be with probably a consortium of different banks. Obviously, this is not announced. On the right-hand side of your screen, you can see the big story that's been going through a lot of headlines recently, the Oracle and ByteDance situation that the U.S. government has found itself intertwined in. The new Treasury terms on TikTok include a proposed U.S. IPO of TikTok in the U.S. The Treasury Secretary, Stephen Mnuchin, sent ByteDance a reserve term sheet late Wednesday night, and the company and both Oracle have reviewed it and think that they're going to move forward, albeit under different terms, to further address national security concerns. Jared Kushner, who advises Trump on if he should sign off, has yet to review it, so we'll see if he's able to provide more color that'll help him decide to pursue the executive order. General Atlantic, Sequoia Capital, and Kuatu Management will also take substantial stakes in the new business and currently have stakes in ByteDance as well. Concessions include, obviously, setting TikTok up as a U.S. headquartered company. Board members need to be American citizens, and also the board would include security committees led by people with government security clearances. This is all for the insurance of national security because a little bit over 100 million American users use TikTok. In addition, ByteDance will retain control of the TikTok algorithm, which is the reason that it's been so successful, because it's able to pinpoint and use machine learning and artificial intelligence techniques to tailor the content to what people apparently want to see. In addition, Oracle will process the data of the United States users, and it will have to verify any changes to the algorithm in compliance with this national security concern. So Sinstrom, the founder of Instagram, has emerged as the candidate to run the US-based version of TikTok. So it'll be very interesting to see if someone with such a unique and seemingly perfectly tailored background would find himself in this position. So that pretty much covers it for the day. Hopefully I'll see you guys Sunday. We're doing a second lecture on mortgage-backed securities. That should be a lot of fun. And obviously next Monday we will have Market Talk.